Hello and welcome to yet another episode of the in-news series. My name is Pooja Dwivedi. Today we are going to discuss how safe is your deposit with the bank in the current crises around the world, especially in the US and Europe. So without any further delay, from the perspective of prelims as well as from the perspective of GS mains paper, third, it is important to analyze the current situation. The news says that the global banking sector is in turmoil. There are raising concerns of contagion effect in the other countries which will impact India as well. The impact on countries like India will be indirect, not direct and multi-pronged as well. There is nervousness in India that has been visible in the stock market, bonds and currencies. So what is the crisis that we are talking about? Now this crisis is because of the interest rate in the US. It has rose by 450 basis points. So it's a good thing, you must be thinking. But Silicon Valley Bank, which is a big lender to the startups there, fell victim to this. Companies have raised very large rounds of funding and all this money was deposited with SVB. Now, in 2020 and 2021, the bank's deposit base rose by $90 billion and the customer base of this particular bank is concentrated among California and the startups there who are already flush with cash and do not need loans. So now the bank, the SVB, it wants to lend loans because it has to earn profit. Now, because these California startups already have a lot of cash, they do not need loans. Now, what will happen? The SVB will be sliding into losses. Because of this, the SVB invested some $88 billion in the mortgage-backed bonds in 2021. Because of the rise of interest, the mortgage will be also rising and then SVB will be in a loss. As the federal increased interest rates, the value of these bonds collapsed. It has eroded SVB's capital base. It has less capital. Now the collapse led to the failure of Signature Bank, which because it is all interrelated, that has created a lot more turmoil for other banks. On Wednesday, Credit Suisse share price it crashed 24% overnight before making a recovery on Thursday following the intervention of the Swiss Central Bank. So Swiss Central Bank also had to intervene. Now startups. For India, the impact will be first on startups. Many Bengaluru-based startups, they have overseas accounts with SVBs and SVB because of the investment in the mortgage based loans, it has done that, not loans, bonds. It has already been in a loss now. On March 10, many realized that they could not access their bank deposits and as SVB was put under federal regulation. Now, the startups need liquidity in their hands to do their daily work. So, because of inaccessibility of the accounts, these startups will be in a loss. The US government and the Federal Reserve had to intervene to safeguard the deposits and prevent a financial system collapse like the 2008. Clearly, not all banks are safe because they have put all the cash in the bank carriers as on a risk. Market has also taken a hit. The crisis impacted bank shares in India because people will become more vigilant about their deposits. And because of this collapse of the two banks, it has not done a systemic issue for India. Depositors and investors fear that the failure of a large bank anywhere could have a chain reaction for other banks because all the banks are interrelated in one way or another. Bond yields are also falling. See, the rise in interest rate, it has led to problems in the bond market. Because on March 13th, the yield on India's benchmark 10-year government bonds, it has declined by 6 basis points to 7.35%. Now, this will reduce the hopes as well as the interest of the general public in government bonds. It has registered a fall of 11 basis points in less than a week. That means it will be very problematic for the government to get loans through bond. If the interest rate in the market rise, investors will not buy old bonds because the new ones that are going to be there, they will be at a higher interest rate. So people will start buying the new ones. As a result, the price of the bond will have to be lowered to increase the yield. When the price is lower, the coupon rate increases because of the lower face value, and that will increase the bond's yield. As yields on a security go up, its price comes down. So for the government, all in all, it is a loss if they do so. Household and retail saving, unlike America's savings are a lot more in corporate. For India, it is mostly in the banks. And a large part of the deposit is with public sector banks, not even private. Even the private banks are very important, such as HDFC, ICICI Bank, Axis Bank. These are too big to fail. With interest rates now going up, savers will be focusing on bank deposits. Moving on. Now, during the reporting quarter ending December 2022, aggregate deposits have increased by 10.3% year-on-year basis. Many banks are offering 7% interest rate on depositors for 15 months. For example, if we take SBI, it was offering just 4.4% last year for a 1-year tenure, and it is now giving 6.98%. It is very high. Moving ahead, in India, the risk related to the deposits of us, it is covered by one thing, by Deposit Insurance and Credit Guarantee Corporation. Now, if I am depositing 50 lakh rupees in a bank, I will be guaranteed that in case any bank fails, I will get rupees 5 lakhs back. However, the government and the RBI had stepped in while some private banks such as Lakshmi Vilas Bank, PMC Bank and Yes Bank faced problems. So none of this sort happened for India. There are certain risks that have been flagged by the RBI's Financial Stability Report, which was released on December 29, 2022. It warned that the risks from global spillover mean one problem spills over to the next area. The spillovers and financial market volatility, it remained high because of the COVID-19 pandemic, breaking down of supply chains, and of course the war. However, it also said that the stress test results reveal commercial banks are well capital based and capable of absorbing the macroeconomic shocks even in the absence of any further capital infusion that could be done by the government. Moving ahead, now there is a widespread expectation that the US Federal will pause the rate hike or raise the federal funds rate by a smaller 25 basis points as its March 2020 meeting. Recent stress in the banking sector has highlighted the financial stability risk in the environment of higher rates, and the sticky inflation momentum revealed in the most recent price and labor market data. It suggests curbing inflation will remain the focus for US monetary policy, and it will of course have an impact on India as well. So let's wait and watch. That's it. Thank you so much for watching.